One of the best investment you can make is a fund that quietly outperforms 90% of Wall Street's top picks in any given year. And the longer you go out, it beats by close to 100%. And almost no one talks about it. If you want a strategy that works without constant guesswork, without constant anxiety and fear, this is the video for you. In this video, we're going to reveal the #1 index fund and ETF that consistently beats 90% of Wall Street's top picks in every given year and with lower risk and higher long-term returns. Well, if you ask our good friend Warren Buffett, it isn't even close. It's the S&P 500. And yes, Buffett doesn't invest in it, but he has very, very publicly said that when he passes away, he tells all of his family, buy the S&P 500. The most legendary investor of all time, the guy who made billions of dollars picking individual stocks, says that the vast majority of people should just buy a low-cost S&P 500 ETF and let it ride. That's it. Simple, boring, and wildly effective. So why does Buffett believe in this so strongly when he has done exactly the opposite? Well, first off, he believes in simplicity over complexity. One of his most underrated quotes is, "The most important quality for an investor is temperament, not intellect." He's saying you don't need to be some sort of genius to win. What you do need is the emotional strength to stay calm, stay invested, and avoid making the catastrophic dumb decisions when the market gets rocky. The S&P 500 helps you do that. It's automated. No decisions to make. No panic selling to worry about. Just own the 500 largest companies in America and move on with your life. And even better, as those companies change, the ETF does all that work for you. Buffett has zero faith in most active fund managers. He once said, when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. What's the translation? You're paying extra to be underwhelmed. You're being overpromised and underdelivered. Active managers don't beat the index. And if they do, it's often because they got lucky, not because they have some repeatable skill set. Buffett has spent decades trying to teach people that over time, management fees pile up and destroy your returns. And that doesn't even include the mismanagement and the underperformance. With an index fund, especially one tracking the S&P, those fees are almost non-existent. Guys, let me tell you the story that I absolutely love about Buffett. It is classic Buffett. Simple, logical, and dripping with common sense. Back in 2007, Warren Buffett made a bold bet that flipped Wall Street on its head. He said, I will bet $1 million that a boring, low-cost S&P 500 index fund will beat a bunch of fancy hedge funds over the next 10 years. Now, if you're new to this, you might be thinking, wait, Buffett, the billionaire stock picker, is betting on an index fund? Yes, because Buffett knows something most people don't get. Fees kill returns. Complexity kills returns. Ego kills returns. So here's how the bet worked. Buffett picked the Vanguard S&P 500 index fund. Literally the most boring, passive, dirt cheap fund you can buy. On the other side was a guy named Todd Seeds, co-founder of Protégé Partners. He was a hedge fund manager. He picked 5 funds. These funds invested in other hedge funds. So he basically had an ETF of hedge funds. So fees on top of fees on top of fees. And the terms were very simple. $1 million, winner takes all. 10 years, 08 to 17. Proceeds go to charity. Now here's the moment I want you to picture. You've got a friend who tells you about this elite hedge fund opportunity. It's private, only for accredited investors. The fees are high, but it's exclusive. You bite. You think you're getting onto something special, but over 10 years you get smoked. By an index fund you could have bought with zero effort and almost no fees. That's exactly what happened here. By the end of the bet, Buffett's S&P index fund gained about 126%, roughly 12.6% per year. Guys, the hedge fund basket, 36%, or about 3% annually. Not even close. Buffett said it best. Performance comes, performance goes. Fees never falter. And this wasn't just about proving a point. It was about teaching a generation of investors something very simple. You don't need brilliance to win. You just need discipline. You don't need to chase complexity. You need patience. You don't need a hedge fund manager. You need low fees and a long-term horizon. Even Ted, the fund manager, Buffett's opponent, eventually admitted Buffett won fair and square. Now, if Munger were here, He'd probably say something to the effect of, you don't need a 160 IQ to know a guy charging you 2% a year to underperform is not your friend. And he would be right. So what's the lesson for you and me? Keep it simple. Avoid high fees, think long-term, and don't fall for the Wall Street smoke and mirrors. Don't fall for the guys who use big terms to sound really smart. I love meeting with these guys because the second I start asking questions, the cracks start to form and they start to deflect. Buffett didn't just win this bet. He proved that smart investing isn't about being flashy. It's about sticking to what works. And the real kicker is, this isn't just what Buffett says to do. It's what he's doing with his own money. As I said before, in his 2013 letter to shareholders, he said 90% of my money will be invested in low-cost S&P 500 index fund. The rest, short-term treasury bills. That's it. So after hearing that story, you're probably thinking, okay, Buffett proved his point. But what does that mean for me? Well, it's very simple. It means that the very thing Buffett bet on, that low-cost S&P 500 index fund, isn't just some theory. It's a real-world strategy that beat the pros, smoked the hedge funds, and crushed the fees over 10 straight years. For decades, the S&P 500 has been the benchmark for U.S. stock market performance. It tracks the 500 largest publicly traded companies in America. Owning it means you own the NVIDIAs, the Apples, the Microsofts, the Amazons, the Googles, plus hundreds of other companies across every sector. So if you're going to invest in the market, this is the index that most people start with. But here's the problem. There are dozens of funds that say they track the S&P. They all look the same. They all advertise the same exposure. But depending on which one you choose, your long-term outcome can shift not because of performance, but because of fees. And those small differences in cost over decades become huge. That's why we're about to break down what an index fund actually is, how ETFs work, and what the S&P 500 gives you, and how paying 1% versus 0.1% could cost you hundreds of thousands of dollars by retirement. So, what's an index fund? Very simple. It's a type of mutual fund that tracks a specific market, index, any sort of thing they want to do, like the S&P. All those companies in there, Coca-Cola, Visa, Home Depot, all the ones I mentioned earlier, you name it, they're in there. An ETF is an exchange-traded fund, which works similarly. It tracks the same index, but trades on the stock market like an individual stock. You can buy and sell it through the day, and both give you instant diversification, owning hundreds of companies in one click. So which one should you choose? Let's start with the traditional low-cost S&P 500 index funds. So these S&P 500 index mutual funds, they don't trade during the day. You buy, and your money gets invested at the end of the day. But the key there is you're still investing in the S&P 500. Now, guys, in everything we're going to talk about here, my big goal is, are you buying the S&P 500? Is the expense ratio low? That's what matters here. It's not as relevant as to which one you pick. It's more about getting that access to it, whether it's a mutual fund, index fund, whether it's an ETF. What matters is, are you buying the S&P at a low cost? Here are the big three. The Fidelity 500 Index Fund. Expense ratio, 0.015. 10-year return, 12.6% annually with no minimum investment. There's the Schwab S&P 500 Fund. Expense ratio of 0.02%. 10-year return, guess what? 12.6%. Also no minimum. The Vanguard 500. Expense ratio, 0.04%. Ready for this one? 10-year return, 12.6%. This one has a minimum investment of $3,000. So the difference isn't performance. It's purely cost structure. Guys, fees compound. I talk about this all the time. This is why it's so important to look at the fees. The longer your time horizon, the more these small expense differences turn into 5 or 6 figure differences in outcome. Now guys, when comparing an ETF to an actively managed mutual fund that charges you upwards of 1%, these differences make big differences in your retirement. 0.015 versus 1% can lead to 6 or 7 figure differences. That's hundreds of thousands, maybe even millions of dollars in difference. So that doesn't even include, by the way, your underperformance based on just not being very good at picking stocks. So what's the most logical thing? Lower price, better performance. That's like somebody coming in and say, hey, would you rather have a Honda Civic or a Ferrari? But we're going to charge you $30,000 for the Ferrari and $100,000 for the Honda Civic. No brainer. That's exactly what we're talking about here. Now, guys, whether it's a 401k, IRA, brokerage account, All of these are ways to invest, including some of these ETFs. So what about ETFs? Well, guys, the only minimum investment in ETF is the price of the ETF. And the top ones are SPY with an expense ratio of about 0.01%. 10-year return, about 12.5%. Launched in 1993, this is the oldest and largest ETF on the market. IVV, iShares Core S&P 500 ETF, 0.03% expense ratio with a 10-year return about 12.6%, issued by BlackRock, second largest ETF in the market. And VOO, the Vanguard S&P 500 ETF, also 0.03% expense ratio, about 12.6% return. Guys, SPY is the oldest, it's the most liquid, but it's also the most expensive of the three. But that expense still needs to be looked at relative to other actively managed funds. So guys, I want to show you guys using our retirement calculator the differences that occur from this Ted versus Buffett kind of challenge. So let's pull up a historical number I did before. So let's say you're 30 years old. You're going to retire at 65. You currently have $100,000 in savings. You're saving $10,000 a year. You're going to increase that by 4% per year. And guys, you're going to make between 9 and 10% a year, dollar cost averaging in a low cost ETF. Because over long periods of time, the historical returns have been about 9.9%. During retirement, you're going to take a little risk off the table, make 7%, live to 95, etc. Bottom line is you have enough for retirement. Yes. You go to retirement age 65, you have $6.6 million in retirement, which is equivalent to about $2 million today. Wonderful, dandy, everybody's happy. Okay, now let's say you invest, and I'm not even going to compare it to Ted's poor performance. Let's say that you just buy a mutual fund that ends up underperforming by 0.5% a year, and then also charging you a 1% fee. So your returns are 1.5% lower. So we're going to take our 9.5% return down to 8 and our 7% in retirement down to 5.5%. Do you have enough for retirement? Guys, you went from having enough in retirement to needing to save $5,000 a year more. You went from $6.6 million in your retirement account to $4.5 million, a difference of $2.1 million. Why? Why? Why did you pay for a Ferrari but get a Honda Civic? I will never understand that. This absolutely costs you a ton of money. Now, guys, we have a great PDF on dollar cost averaging, absolutely free. If you want more of this, please do yourself a favor. Click the link below. We will email it to you immediately, absolutely free of charge, like always, for our PDFs, because we truly believe in wanting you to have the access at your fingertips to be able to remember these things over and over. Now, do I believe it's impossible to beat the market? No. Do I believe it takes something more than just understanding the numbers? Absolutely. There is a way to potentially beat the market while investing in ETFs. So click on the next video to see the 3 ETFs that I think would beat the S&P 500 over a long period of time, because great investors don't just settle for average. And in this video, you're going to learn a simple way to beat the market using these 3 ETFs. Thank you for your time.